Have you ever looked at a bank stock and just felt lost? Like you're not getting the full picture? You are definitely not alone. In this explainer, we're going to cut right through all that noise and get to the 5 numbers that truly matter, the ones that tell you everything about a bank's real health and its potential for growth.
So what's the secret sauce? What really separates a top-tier bank from just an average one? Well, I can tell you it's not just about a fancy logo or even the stock price itself. The real answer is hiding in plain sight, in just a handful of key metrics that show us how a bank actually works.
You see, analyzing a bank is a whole different ballgame. It's not like looking at a car company. A bank's raw material is money itself. So the usual rules just don't apply. To really get what's going on, you have to learn to speak their language. And that's exactly what we're going to do today.
Here's our game plan. First, we're going to follow the money. Where do banks get it and how cheap? Then, we'll look at the biggest challenge, risk. After that, we'll uncover the real cost of their money, see what fuels their growth, and finally, we'll connect all the dots. Sound good? Let's dive in.
Okay, first things first. It all starts with a hunt for cheap money. A bank's #1 job is to bring in deposits. But here's the thing. Not all deposits are created equal. The name of the game is to get that money for as little as possible. And that brings us to our very first metric, the CASA ratio.
So what is CASA? It's simple. Current accounts and savings accounts. And think about it. Current accounts pay you 0 interest, right? And savings accounts pay next to nothing. This is the absolute cheapest money a bank can get its hands on. So a higher CASA ratio means the bank has a ton of low-cost raw material it can lend out for a nice profit.
And just take a look at this. Kotak Bank is leading the pack here with a huge 52% of its deposits coming from these super cheap sources. Now, on the surface, that looks like a massive advantage, right? It seems like they're in the best position possible.
Okay, so the bank's got its pile of cheap money. Now what? Well, now comes the hard part, lending it out. And lending is always risky. The single biggest make-or-break challenge for any bank is making sure they actually get paid back. And that's where our second metric, Net NPA, comes in.
Net non-performing assets. Yeah, it's a mouthful. But really, NPA is just a fancy way of saying bad loans. It's the percentage of the bank's loans that have gone sour. A low net NPA is the ultimate sign of a smart, disciplined bank. It proves they're absolute pros at the most important part of their job, picking winners. And get this, look at HDFC Bank. Their net NPA is an incredibly low 0.4%. Let me put that in perspective for you. For every $1,000 they lend out, only $4 go bad. That is an insane level of control, and it's a huge reason why they're seen as a world-class institution.
All right, so we saw Kotak's amazing CASA ratio. So they win, right? They've got the cheapest money, case closed. Well, not so fast. This is where it gets interesting. That high CASA ratio, it might not be telling us the whole story.
And that brings us to the cost of funds. This number cuts through all the noise. It's the true all-in average interest rate the bank pays across everything, CASA, fixed deposits, you name it. This is the metric that reveals the real bottom line. So let's see if Kotak's high CASA really translates to cheaper money.
Okay, so let's revisit this, remember? Based on CASA alone, Kotak Bank, sitting pretty at 52%, looks like it's in a way better position than HDFC Bank at 42%. But is that what's really going on? And here is the big reveal. Would you look at that? Despite having a lower CASA ratio, HDFC Bank's overall cost of funds is actually lower than Kotak's. So what happened? Well, to attract all that CASA money, Kotak had to offer much higher interest rates on its savings accounts. So while the ratio looked great, the actual cost to get it was higher. See? This is why you gotta dig deeper.
So, a bank's got its costs under control, it's managing risk like a pro. What's next? Growth, of course. But to grow, you need fuel. In the world of banking, that fuel is capital, and we measure it with our fourth key metric. It's called the Capital Adequacy Ratio, or CAR. The easiest way to think about it is as the bank's financial safety cushion. Regulators say, hey, for every dollar you lend, you have to keep some of your own money aside, just in case. A higher CAR means a bigger cushion, which gives the bank more firepower to lend more and grow faster. If that number dips below 12%, that's a big red flag.
And you can really see the difference here. HDFC and Kotak are both sitting on a really healthy cushion, around 17%. They are fueled up and ready to grow. But then you look at a bank like South Indian Bank, and they're operating with a much thinner safety net, which really limits how fast they can expand.
Now, having that strong capital base directly powers our final metric, advances growth. Advances is just bank speak for loans. So this metric is super simple. It just tells us how fast a bank is growing its loan business. A bank with a high CR, like Kotak, can easily support strong growth, in this case, a really impressive 21% year over year.
So, we've looked at 5 different numbers, but here's the most important part. They don't exist in a vacuum. They are all linked together. They create this powerful chain reaction that really defines whether a bank is going to be a winner or a loser. Let's put it all together now.
And here it is. This is the whole banking business model in one beautiful, virtuous cycle. It all starts with discipline. Keep your bad loans low and keep your funding costs down. When you do that, you protect your capital. A strong capital base then acts as the fuel for loan growth. And of course, that growth is what drives bigger profits. It all flows together.
You know, our source material just puts it perfectly. Control NPAs, bring in CASA, increase capital adequacy, which will increase loan growth, which will increase profits. It's a simple formula, right? But doing it consistently is what separates the great from the good. You control your risk, you get cheap funds, you build up your capital, and that earns you the right to grow.
So there you have it. You now have the framework. You can speak the language of banking. The next time you look at a bank, you won't just see the stock price. You'll know to look for that virtuous cycle, or for the warning signs. You can see the real story for yourself. So the only question left is, which bank are you going to analyze first?